the stock market is soaring. But if you look a little closer, you'll see this real tug of war going on.
Yeah, definitely. Between like shifting economic policies on one hand and some pretty deeply held beliefs about what actually drives prosperity on the other.
Exactly. And our mission today is to kind of cut through that complexity.
We're doing a deep dive into the forces influencing the stock market performance. Everything from interest rate decisions, government policies.
Right, even down to the political viewpoints shaping how people see the market.
Yeah, we want to give you the clearest possible picture of the dynamics really at play.
Okay, so let's dive in. What's happening right now? Because you look at the U.S. economy, and there are some genuine slowdown risks.
Oh, for sure. We're seeing like weaker job growth, consumer spending seems a bit subdued.
Yet somehow equity markets are showing this surprising resilience. How do you square that circle?
It's fascinating, isn't it? I think one of the biggest factors overriding those sort of bearish signals is really the Federal Reserve's pivot.
Ah, the Fed. Okay.
Yeah. Remember last September, they made that pretty significant move, cut the federal funds rate by 50 basis points.
Right, down to that 4.75% to 5% range. First cut in over 4 years, wasn't it?
Exactly. A clear signal, shifting towards maybe stimulating growth a bit more.
And it's not just that one cut the market's looking at, right? The Fed's own dot plot, their forecasts, they're pointing to more cuts.
Yeah, the projections suggest maybe a total of 4 rate reductions by 2026.
And historically, falling rates are kind of like jet fuel for the market, aren't they?
Generally, yeah. They reduce borrowing costs for businesses, makes investment cheaper, can lift corporate earnings.
Goldman Sachs even put a number on it, I think. Something like 5 smaller cuts could boost the S&P 500 by, what, 8 to 12%?
That was their estimate, yeah. Which is, pretty serious potential tailwind for stocks.
It is. But it's not just about the Fed, is it?
No. Absolutely not. And this is where it gets more complicated. Because alongside these rate shifts, you've got other things happening. Aggressive policies like tariffs, for instance.
Championed by figures like former President Trump, yeah. Those add a whole other layer.
They really do. And they spark intense debate about the long-term market impact. So what we're unpacking today is really how all this stuff weaves together the economic data, the Fed's moves, political philosophy.
Okay, that sets us up perfectly. Let's start with the Fed's direct influence, interest rates and market movement. It feels like a fundamental relationship almost. Rising rates pressure stocks down, falling rates tend to boost them.
That's the textbook relationship, yeah. And the Fed manages this mainly through that federal funds rate.
The rate banks charge each other for overnight loans.
Exactly. So when the Fed increases that rate, money gets more expensive across the board. It kind of shrinks the money supply, discourages spending. That's their tool for fighting inflation.
And the reverse. Decreasing the rate
makes borrowing cheaper, encourages spending, encourages investment, stimulates the economy.
So the stock market might react almost instantly to a Fed announcement.
Oh, yeah, often does.
But the real-world effects, hitting the broader economy, that takes longer. Maybe a year or so.
That's generally the lag time people talk about, yeah. Around a year for the full effects to ripple through.
Yeah.
And it's definitely not the same impact everywhere.
Right. Different sectors react differently. Who tends to win or lose when rates change?
That's a great question. So when rates are higher, think about the financial sector. Banks, brokerages, insurance companies, they can often benefit because the spread on their lending gets wider. They charge more for loans.
Okay, so financials like higher rates. What about lower rates?
When rates fall, sectors that pay reliable dividends often look more attractive. Think utilities, maybe real estate investment, trusts, REITs.
Because their dividends look better compared to lower bond yields.
Yeah, exactly. And also, large companies with really stable cash flows, they benefit too because they can refinance debt more cheaply.
Makes sense. What about growth stocks? Those tech companies, maybe, that are priced on future potential.
Growth stocks. They're particularly sensitive. When rates rise, these companies, whose value is really tied up in future earnings, tend to become less appealing.
Why is that?
Well, 2 main reasons. Higher rates mean you discount those future earnings more heavily when calculating their present value. And second, these companies often rely on borrowing to fund their growth, and higher rates make that debt financing more expensive.
So it kind of hits them from both sides.
Pretty much. It just makes their future look a bit less certain, or at least less valuable today.
Okay, that leads us nicely into a topic that always generates discussion. Conservative economic policies. driving market performance. When people say pro-business policies, what are we generally talking about?
Usually it means things designed to shift resources towards entrepreneurs, towards businesses. So, corporate tax cuts, deregulation, maybe investment incentives, creating a favorable environment, supposedly.
And is there evidence this works for the market? I know there was a UK study.
Yes, quite a well-known one. It looked at the UK stock market way back, from 1885 to 2015, and it found a, quote, significant positive correlation between the Conservative Party's rule and the total returns of the UK stock market.
Wow, that's a long time frame and a pretty strong finding.
It is. The research even suggested that left-leaning governments might, quote, scare investors rather than attract them. Strong words.
So the thinking behind that is the Conservative Party is seen as supporting what? Low taxes, free markets.
Yeah, low taxes, free market, limited government intervention.
Yeah.
The idea is that encourages private sector growth.
Whereas the Labor Party's focus, more government involvement, worker protection, redistribution, that's seen how?
Potentially as increasing costs for businesses, maybe creating more uncertainty for investors and therefore having a negative impact on the market. So yeah, it's less about specific policies sometimes and more about the overall philosophy.
And you hear similar arguments in the U.S. context too, right, from a conservative perspective.
Absolutely. You often hear confidence expressed in the U.S. economy, sometimes linked to having a, quote, strong leader who will enable American corporations to feed on the rest of the world. That kind of viewpoint.
Right. And the idea that maybe some policies might cause, temporary pain, but they're necessary for long-term health.
Exactly. Sort of like a household having to stop overspending to get its finances back in order.
I've heard that analogy, like the market needs a painful detox from government spending addiction.
Mm-hmm. The idea being that past government intervention created an artificial boost. And maybe some current struggles are just a necessary correction.
Okay, so that's one perspective. But it's crucial we look at the counter-arguments, too.
Absolutely essential. And the Center for American Progress, for example, offers a very different take.
What do they argue?
They argue that those laissez-faire supply-side policies, especially tax cuts aimed mainly at the wealthy, actually resulted in the, quote, weakest expansion in post-World War II U.S. history.
Weakest? How so?
They point to things like tepid job growth, weak private investment, stagnant family incomes during periods dominated by those policies.
And they also connect it to the 2008 financial crisis.
Partly, yes, suggesting that a disdain for prudent regulation contributed to the meltdown. They also criticized specific actions, like changes to the Recovery Act back then.
Claiming those changes stripped out more effective job-creating provisions.
Yeah, and led to, they estimate, maybe 500,000 fewer jobs than could have been created otherwise.
And they also point fingers at blocking other measures like small business aid or help for state governments.
Right. Arguing that what they call conservative obstruction to things like small business lending, aid to states, extended unemployment benefits, that these delays actually harmed the economic recovery.
So it's a really stark contrast in how different groups view the same economic history and the impact of policies.
It really is.
Yeah.
It's not just a debate about numbers. It's about fundamentally different beliefs on how you actually create prosperity. And understanding that ideological tension is key for you, the listener, because it constantly shapes market confidence and policy direction.
Okay, let's shift gears slightly to tariffs. Tariffs, a double-edged sword for the market. They're definitely seen as a major external risk factor.
No doubt about it. They can really move markets.
And from one conservative viewpoint, tariffs are sometimes framed differently, right? Not just as a cost, but as
a means to an end.
Yeah.
The argument goes that the end goal is getting a better deal for the USA.
And the thinking is the U.S. economy is big enough to handle any blowback.
Essentially, yeah. That we can take a hit from trade partners and that eventually domestic producers, farmers, they'll benefit by selling more here at home, making up for any losses. It's presented as a long game strategy.
But what about the real-world impacts we're seeing now? I read the effective U.S. tariff rate has nearly doubled recently to around 18%.
That's the figure being reported, yeah. 18%. That's a huge jump, and it has real consequences.
Especially for small businesses, I imagine.
Absolutely. They're often cited as the engine of job creation, over half of U.S. jobs. But they're facing potentially hundreds of billions in annual tariff costs. Plus, just navigating the complex rules, it's much harder for them than for big corporations.
Yeah, you can imagine. Trying to import goods and suddenly facing an 18% surcharge, that's gotta hurt.
It's a direct hit to their bottom line, their ability to hire, maybe even survive.
And these trade tensions play out internationally, too. That example of the U.S.-India stalemate over agriculture.
Right. It highlights the conflict between domestic politics, like protecting local farmers, and the demands of international trade. And the scale difference is huge, isn't it? Average farm size in India, just over a hectare. In the U.S., closer to 190 hectares. Makes direct competition really difficult.
So tariffs have these complex economic effects, too. Sometimes inflationary, sometimes deflationary.
Exactly. Initially, they can push prices up, inflationary. But then, if businesses absorb the costs or consumers cut back spending because things are too expensive, it could become a drag on growth, deflationary. But there's always that lingering risk they could just reignite inflation.
So bottom line, tariffs add a lot of volatility and uncertainty.
That's the key takeaway. They make forecasting market outcomes much, much harder.
Okay, let's zoom out again. Navigating broader market risks and shifting sentiment. We've seen this incredible market run the S&P 500 surging, 29% since April 2025?
A historic run, yeah.
But some analysts are saying the market seems complacent. That sounds worrying.
It does raise a red flag, definitely. And there are some concrete economic warning signs that seem to support that concern.
Like the labor market.
Yeah, first off, the labor market is clearly slowing.
Yeah.
That July jobs report adding only 73,000 non-farm payrolls. The 3-month average is really weak, like 35,000. That's way down from a year ago.
Less than a third of the pace. And continuing unemployment claims are up too.
Substantially since April, yeah. That's a real sign of strain.
And what about corporate earnings? The headlines look good, 80% beating estimates.
Yeah, but you have to look beneath the surface. The performance gap is huge. Those magnificent 7 mega-cap tech stocks, their earnings grew 26% year over year. Amazing.
But the rest of the S&P 500, the other 493 stocks.
Barely, just barely positive growth. That concentration is a risk in itself.
And inflation isn't completely gone either, is it?
No, still lingering. Core CPI, excluding food and energy, was up around 3% annually in June and July. And market indicators, like those inflation swaps, suggest it might even tick up towards 3.3%. Price stability is still a challenge.
We're also seeing more bankruptcies.
Yeah, among large U.S. companies. The number filing in the first 7 months of 2025 was the highest for that period in 15 years.
Yeah.
That tells you there's real stress out there.
Wow. And consumers are taking on more debt.
Record levels, actually. Household debt hit $18.39 trillion. Credit cards, student loans, auto loans, all hitting new record highs. That raises big questions about how long consumers can keep spending.
So you have all these underlying warning signs, but the market sentiment seems almost bubbly.
Yeah, it really has those late cycle melt-up characteristics. Lots of speculation, valuations look stretched by historical standards. You had that survey where 91% of global fund managers think U.S. stocks are overvalued.
91%.
And retail investors are jumping in.
Enthusiasm is surging. Some people are comparing it to the excesses of the late 90s dot-com bubble.
Not a comfortable comparison.
Not at all. Because that kind of environment where prices seem detached from the fundamentals and gains are super concentrated, it's historically been very vulnerable to sharp corrections.
That concentration in the Mag 7 is a big part of that risk then.
It is. If those few stocks stumble, it could pull the whole market down disproportionately. So the takeaway is, while the surface looks strong, there's this complex web underneath economic challenges, potential speculation. Okay, so wrapping this up, we've really peeled back quite a few layers today. It's clear the stock market isn't simple. It's this dynamic dance.
Influenced by the Fed's interest rates, specific government policies, global trade, tariffs, all interacting.
And what really stands out is the role of ideology, isn't it? How different political views lead to different policies, different interpretations of what's even healthy for the market.
Absolutely. It drives so much of the debate and the uncertainty. These aren't just economic disagreements. They're often deeply philosophical ones about how wealth is created and distributed.
So as you, our listener, consider all these forces, the rate cuts, the policy debates, the warning signs, the market highs, what does this current market resilience truly signal to you?
Is it genuinely robust health? Or is it more like a delicate balance based on expectations that could shift really quickly?
What factors do you think will ultimately be the deciding ones for the market's path forward from here? Something to definitely keep thinking about.